Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and today we've got something a little bit different. We're going to do an Ask Me Anything with Marcus Padley, the founder of the popular Marcus Today newsletter and also a fund manager. Marcus, great to catch up.
Thanks, James. And let's be clear, you haven't prepped me, so I don't know what's coming.
These questions are unseen. Thanks to all of you that did send through your questions. I've got them segmented into a bunch of themes, and I've got your names here, so I'll call them out. And Marcus has very kindly agreed to go through these questions with us. So let's get started. First topic, ETFs versus stocks and investment vehicles. ETFs or stocks? This one's from Rosemary. If it's both, which class for which age group?
I would say I should be an ETF salesman now, because after so many years of dealing with individual stocks and seeing people trying to trade them and seeing the average Australian with their 20 stock portfolio, you can achieve exactly the same thing with an ETF. As I say, I should be an ETF salesman because it suits
young, old.
Young, it particularly suits young, and it suits old for peace of mind because they are less volatile generally. And they allow you to invest outside the US, outside the Australia, which you have to do at the moment. Yep. And they are allowing you to exploit themes that you simply couldn't get. And my humble opinion, themes are far easier to get right and time than individual stocks.
Okay, thanks, Rosemary. Next question is from Julie. Thanks for this opportunity, she says. I didn't tell you it was happening. So.
Hi, Julie. Hi, Julie.
My son has been working extremely hard for the last 6 months and has amassed a good amount of money. He wants to invest it in the stock market. He's thinking of IVV, which is an S&P 500. I'm extremely nervous about the American situation at the moment, understandably. He's worked so hard, I'd hate to see it all for nothing. Thank you, Marcus.
Julie, I don't think your son can take on the market without taking on a risk. So there is no guarantee. So if he's going to do that, he has to take the volatility with him. And the good thing about that is if he does go underwater, lose money, he's going to get a really good lesson. Yeah. For instance, one of my daughters bought a gold stock once. It literally went to zero. She blew every single dollar, and she's made life-changing decisions about the stock market ever since then. So he will have his own experience. Let him have it. If he loses some money, it's money well spent in a way because he's getting an education. And if you're really concerned about it, hasn't he got some wealthy grandparents who could cover him?
Well, the good thing about something like IVV is it won't go to zero.
Absolutely. There you go. So it is one of the least volatile ETFs that you'll find, the S&P 500, and we've just had a moment coming out of it. If just watch out for the big ones where the world loses faith in the US bond market. That is the big one. We've been waiting for it ever since they printed the first dollar. If you read about that on the front page of the Herald Sun, you know something's going wrong. Get him out.
Next question is from Peter. Hi, Marcus. You have recently been keen on some ETFs. If an ETF is based on the MSCI, does it have too much exposure to US stocks? Thank you.
There is. It depends which
index it is.
Which index it is. So you've sort of got the question wrong in a way. Everything's empirical. It's a bit like ETFs. Go and have a look at what they hold. There's no debate. You don't need debate. If it's got a lot of US in it, it's got a lot of US in it. Go and have a look at the details. The ETF providers are very good at providing details on what every ETF's got. So you'll then find out if it's got a lot of US in there or not.
Okay, great. We're going to switch to some thematic investing. Question from Kim. Would you invest in lithium or any of the other battery metals now? Do you think lithium can still fall further?
If the question is now, no. If the question is, would I invest in lithium battery? If that becomes a theme, absolutely, because themes come and go. I do think, though, it's a little bit like the Dutch with their tulips. We had tulip mania in the 1600s, and they're still very attached to their tulips. So we had a lithium battery boom 2 years ago, a year ago, and it's just been going one direction ever since. People are still very attached to stocks that went up a lot in the past. So I would say for the moment, read the writing on the wall. The lithium price is becoming a commodity, and the price is going nowhere. I'm not excited. I am amazed that every time the resources sector has a rally, everyone piles back into lithium. If you look at mineral resources, Pilbara, they've destroyed more wealth for Australian investors than possibly any other stock in recent history. And you need a significant turn in the underlying commodity price to change that, and it's not happening.
This question comes from Les. Hi Marcus, I'm an 83-year-old investor and have seen it all before. I've never been able to understand the flight to gold when things go bad in the share market. I've seen nothing over 83 years to convince me that gold is any less volatile than any other investment. Please enlighten me.
Well, you'll see what gold has done. Gold has been a phenomenal asset class ever since 2003, 2005. What happened in 2003, 2005? They started a gold ETF. This might sound silly, but let me just explain. All the gold in the world dug up if you put it in a cube, it's 20.4 meters by 20.4 meters by 20.4 meters. And it grows by 2% per annum, gets consumed, electronics, jewelry lost, 2% per annum. So it just sits there, an inert piece of metal, it doesn't earn anything, it hasn't got a yield. And if the lump of gold was sitting there and seeing its price going, it'd be going, what's going on? Everyone's mad because I'm not doing anything, I'm just sitting here. But the reason gold will go up is if you were to double the number of US dollars on issue by printing them, and the gold is priced in US dollars, it's going to double in price. So the further the US goes into debt, the only way, if the big one happened, everyone loses confidence in the US bond market, the US dollar is going to get printed again because that's their only way out of it, and the gold price is going to go up because dollars are worth less. So it's more of a currency play long term than the gold price. As far as is it a good investment, no, because it doesn't return anything, it hasn't got a PE, it hasn't got a yield, so it's not really an investment. It's a price play, and it's more a play on how many US dollars are printed than anything else. Of course, there have been a lot. So that's why it's done well, and the market will continue to go, especially when that bond market freak out. The people will go to it when the market falls over, and on that basis it becomes a short-term trade. So you could almost, if you were watching our portfolio when we sell the market, buy gold, because it will probably do well. And it went up 32% in the first quarter of this year. So.
Another question, this one's from Tom. His question is, are you not nervous about the fact that the US 10-year bond yield has been rising and equities have been rallying at the same time, given that the stocks are often valued against that 10-year yield?
Yeah, you should. If you look at big institutional fund managers, they'll go, let's come out of equities into bonds or out of bonds into equities. So you tend to see bond market rally when the equity market goes down. The mere fact that, bond yields are scary, okay? You have to watch out for the loss of confidence, but I think at the moment they're just responding to tariffs, inflation fears. We don't need to guess what's going to happen. We'll just wait to see how it develops. And if the bond market does become an issue, we'll be doing something about it. But we're not going to. Of course, it's possible, but everything's on a balance of probabilities. And every investor might try this. So we've got this thing where we just say, what's the likelihood the market just bottomed? Or 60, anywhere over 66%, and you just say it, what you think, because that's your brain working. It's an algorithm. All your inputs come out with a number. So I would say there's a 70% chance the market's just bottomed for the year. In which case, at the moment it's over 66%, it's twice as likely than the alternative. If it's twice as likely, it's probably worth investing in. So it's only 66%. So the probability of a bond market collapse at this point is probably 10%. It's not worth worrying about.
Couple of stock-specific questions. Now, I know you're probably not quite as close to the stocks anymore as you were in the past, but I'm going to...
Oh, no, we are. We run two other portfolios in the newsletter, an income portfolio, growth portfolio. Yeah, still very interested in the stocks.
All right, well, this question comes from Jerry. How come analysts have a hold and a sell on Bank of Queensland and has climbed $1 in 4 weeks?
You need to talk to the analysts. And all the analysts have been wrong on the banks in perpetuity anyway. If you look at the Commonwealth Bank, it's because they rate them on a PE and compare them with international banks, but they're very different to international banks because they don't have any competition. You open a bank account in the UK, you'll have 20 banks to open a bank account with. The NAB, CBA are not competing with Citibank. They're not competing with UK banks. So they go to a premium. And the analysts are still viewing them a bit on a PE basis compared to the world, and that doesn't really work.
Next question comes from Wendy. Hi Marcus, where do you see the future for WiseTech?
WiseTech. Wouldn't like to make any judgments, but generally speaking, in broking and in advice, why would you go where there is stuff you're not proud of?
Yeah.
Just don't need to dive in where things are not joyful.
Yep.
So WiseTech will move around on tech sector sentiment until they solve their image problem. I wouldn't be bothering with it. I don't need to bother with it.
Question from Alex, a question about Poseidon Nickel from back in 2021. Is this a stock that you still own? Do you still like the company?
No, don't own it. It's struggling with its own existence at the moment. The reason Poseidon Nickel came up in that question is because we have this thing in the newsletter called One Stock Portfolio, and I'm not sure what year it was. Did
2021?
we say? In 2021, we decided to, if you had to name a one stock portfolio stock, what would you name? So everyone in Marcus today did one. I picked Poseidon. Henry picked Brain Chip. I think when he picked Brain Chip, it was 40 cents. It went over $1. When I picked Poseidon, it was 3 cents. It went to 16 cents.
Right.
And that was the opportunity.
A bit of a game.
It was a bit of a game, and I am constantly abused for picking it, and it's now gone bust because of Indonesian nickel came along and killed the Australian nickel market. But every recommendation has a time frame. If you read the newsletter, you wouldn't know that.
Okay, very good. This one's from Patrick. Is the market rewarding size for its own sake? Has something akin to Google effect taken hold where the bigger stocks grow bigger simply by virtue of being big?
Possibly. There's that idea that exchange-traded funds are dragging bigger stocks to be bigger, and then they get bigger. Maybe. I don't have a specific answer for that.
Okay.
But certainly true if you were to look at the volatility of individual stocks and size, they do progressively get more volatile the smaller they get, unless they're resources, in which case they can be quite big and still very volatile.
Next questions are on your market timing strategy. So the first one, if the market moves lower from here, will you sell the securities you recently purchased? And would you consider your approach as being a pure trader?
No, not a pure trader. Our stated process is to participate in bull markets, avoid precipitous moments. We had a precipitous moment. That's why we've done what we've done. If you ask me 2 weeks later after we've bought back into a recovery rally and caught a 14% rally in 2 weeks, if you ask me now, oh, are you just a trader? Well, it looks like it, doesn't it? But the reality is we want to sit there holding IVV and FANG and the NDQ ETFs and outperform Australia, and hopefully we can do that all year, sleep at night, make money, and that's what we prefer. So no, not trying to time things. The beauty of what we do, or trade things, the beauty of what we do is we're prepared to be decisive, and that's possibly one of the biggest failings of retail investors, the inability to make a decision. We will make a decision. And the other thing we do, we're hyper vigilant. We make decisions every day based on what's happened. And we've got a team of us discussing it. And we've got a lot of experience. So traders, if we have another precipitous moment next month, yes, call us a trader. Don't really care about your label.
Yep.
But
well, your capital
we're there.
can't grow if you're not in the market, can it?
No. So we're there hoping for a bull market. but we'll try and protect ourselves from precipitous moments.
I want to try and paraphrase this question from Graham, and I hope I capture the sentiment for you, Graham. But what he's effectively saying is it appears that there are times in the market when prices are high or prices are low, where the risks are elevated and they're the highest inflection points, and the greatest gains and losses can occur at these times. So he's saying surely there is enough profit to be made by avoiding these high risk times and investing when we assess that the risks are lower. So I guess the question is...
No,
because your strategy seems to focus
chickens,
on...
I think your Chris Conway quoted me the other day, chickens don't make money. So if you're going to do everything in low risk, you're going to wait until there's certainty. And by the time there's certainty, there's no return. Yeah. So you can't avoid these. If you talk to professional fund managers through the centuries that have thought that the market's overpriced only to see it go much higher relentlessly, and the market is littered with them. So I get the idea, yes, can't we just avoid these bits? But when are those bits? And that's the problem, you don't know when they are. We will try and avoid the bad bits because we identify a pivot point based on all its ingredients at that particular time in the market, and we try and identify the bottom based on all the particular ingredients. The next one will be different, and actually that's the best bit of the market. The gains at the bottom, if you think of all the exponential moments before the 87 crash, the market was up 110% in a year or something. Those are the best bits. The best bits are when people lose their heads, are doing 200 miles an hour with their hair on fire. Those are the best bits. If you were to recognize everybody's doing 200 miles an hour with their hair on fire and go, I'm out, you'll miss the best bits.
Yeah, you got to. I agree. You got to look for those moments.
You've got to watch the herd. I can't tell you, James, but one of our things is watch the herd, don't join the herd, exploit the herd. The only way to do that is be entirely empirical, to be Spock, cold, unemotional, do the numbers, make decisions, and not to be at all biased, emotional. Don't listen to too much from the parties that want things to happen. Just be cold. Watch the herd, exploit the herd, don't join the herd.
Okay. All right. The last question, I think it's actually quite a good one to finish on. It comes from Leigh, who sent it in via Twitter. I would love to hear more from Marcus about the flexibility of individual investors. He talks about how they can have an advantage over institutional investors, and a great timing just recently moving into and out of cash. So maybe you could talk about what you think are some of the advantages of...
Right, huge advantages of being an individual investor. And this is, again, part of that construct. The construct of the funds management industry, they can't avoid the fact that they run billions. So they're not going to say, cash out. They can't. And they also have mandates that force diversification for prudence sake. So they will have something that says they can only go to 20% cash. They have to hold so much in bands in particular asset classes. So they've hobbled themselves into a mediocrity. And the big advantage of individual investors is that they aren't hobbled at all. So they can do whatever they like. Also, big institutions have liquidity problems. Individual investors generally don't have liquidity problems. The funds management world generally works by committee, which means in action. And you have yourself to abuse or slap on the back, but you can do whatever you like, whenever you like. And also, I'm not sure that one of the best bits being an individual investor is it's a hobby. It's fun. You can make a social life out of it. You can attend conferences. You can have an intellectual input. The worst thing in retirement is having nothing going on up here, right? So this is a fabulous hobby for self-directed investors to be doing this. And funds management has all the restrictions on it. You don't have any. Only got yourself to blame. Great hobby, meet people, and hopefully succeed and look after your own, change your own standard of living with your own brain. I mean, what better activity could you have sitting at home?
A bit of alignment. Marcus, we're going to wrap it up, but I just have a question from myself to you. Does your gut turn when you are implementing your market timing decisions? So at the top, when you go all out, is your hand shaking as you're implementing your strategy, and vice versa when you get back in? And how do you manage your emotions and nerves?
James, it's an interesting question, and I've often hoped someone had written a book about it, because I think every fund manager goes through it, is have I got it right? Especially when you're making quick decisions like top of the market, bottom of the market.
And with other people's money.
With other people's money. It's a real responsibility, but you can trick yourself into not shaking your hand by saying, oh, relative performance is what's important. There are all sorts of tricks to make you as an individual not care as much. But I care. My hand shakes all the time. But I have got a team around me. We do have a process, and that protects me mentally from the stresses of looking after other people's money, because I think we've cracked it. This year's going to be really interesting. We'll see how we go. But if we produce 20% returns per annum,
they'll be writing books about
we'll be
Marcus.
running $1 billion. We'll be running $1 billion, before too long. And wouldn't that be absolutely fantastic? And money talks. So we'll let the process unfold this year, and without distraction, without being all the things hitting the windscreen trying to stop us. We're pedal to the metal, and we ain't stopping till we see God on the finish line.
Very good. Well, best of luck to you, Marcus. Thank you for being a good sport and for taking the time to answer the questions of a number of Livewire readers. I really appreciate it.
Thanks, James, and thanks, everybody.
Ladies and gentlemen, I hope you enjoyed that video and appreciate Marcus taking the time to answer a few of your questions. Remember, check our YouTube channel. We're adding fresh content just like this every week.